The Great Depression crash. It started on October 24th, known as Black Thursday, and the selling accelerated until Black Tuesday. The market lost 89% from peak to bottom over the next 3 years. It was caused by insane margin lending. Banks let people borrow 90% of the stock price. When prices dipped, everyone got margin called at once, triggering unstoppable panic selling. Circuit breakers are automatic trading halts triggered when prices fall too far and too fast, giving everyone time to breathe and stop total chaos. However, they didn't exist back then, leading to the Dow, an index of 30 major U.S. companies unable to recover for 25 years. Oil shock crash. It was triggered by the OPEC oil embargo. Arab nations cut oil to the U.S. in 1973 because America sent weapons to Israel during the Yom Kippur War. Oil prices quadrupled in months, inflation soared to 12%, and the economy entered stagnation. The S&P 500 fell 48% over nearly 2 years, one of the longest bear markets ever. Black Monday. It happened on October 19, 1987, when the Dow plunged 22.6% in a single day, still the worst one-day percentage drop in history. It was caused by brand new computerized portfolio insurance programs that automatically sold futures contracts the moment prices dropped, creating a feedback loop of endless selling. The market recovered in roughly 2 years. Japanese asset bubble collapse. It began when the Bank of Japan sharply raised interest rates in 1990, popping the biggest stock and real estate bubble ever seen. The Nikkei fell over 80% from its 1989 peak and has still not returned to that level even after 3 decades. Dot-com crash. It was fueled by internet companies with no profits trading at insane valuations. When reality hit, the Nasdaq crashed 78% from its March 2000 peak. It took 15 years for the index to surpass the old high again. Pets.com went from being publicly released to bankruptcy in under a year. Global financial crisis. It was triggered by the collapse of the subprime mortgage market. Trillions of bad loans were labeled as safe, and then they all crashed. Lehman Brothers went bankrupt and credit markets froze. The S&P 500 dropped 57%. Central banks and governments had to inject trillions to prevent total collapse. 2010. Flash crash. It occurred on May 6, 2010, when the Dow suddenly plunged nearly 1,000 points in 36 minutes, and then recovered most of it the same day. It was caused by a single massive sell order combined with high-frequency trading algorithms spiraling out of control. The market recovered in roughly 3 years. European debt crisis. People were scared that countries like Greece, Ireland, Portugal, Spain, and Italy couldn't pay back their debt. The U.S. even lost its AAA, their safety credit rating, for the first time. Markets fell sharply until Mario Draghi promised to do whatever it takes. Chinese stock market. It started when the Shanghai Composite plunged 40% in just 2 months. The Chinese government banned selling and arrested short sellers, yet the crash spilled globally anyway. Volmageddon. It exploded on February 5, 2018, when the VIX, a number that measures market fear, suddenly jumped from 17 to 50 in just hours. It was caused because people bet billions of dollars that the market would stay calm, but when fear spiked, those bets were wiped out in one afternoon. COVID crash. It was the fastest 30% drop in history, happening in just 22 days when countries closed businesses because of COVID. Circuit breakers halted trading 4 times in 10 days. The Fed responded with unlimited money printing, turning it into the shortest bear market ever, 33 days. Inflation bear market. It was driven by the Federal Reserve since they raised interest rates faster than they had since the 1980s to try to lower 9% inflation. The Nasdaq fell 33%, crypto lost 75%, and for the first time ever, both stocks and bonds crashed over 20% in the same year.